Hi guys, we'll be kicking off in about 30 seconds from now, but welcome, good morning, good afternoon, good evening, wherever you are, and welcome to the LiveSquawk ECB preview show. I'll introduce my guests in a bit, but we'll just turn midday London time. As I said, welcome, and again, the idea, for those who don't know who we are, LiveSquawk is an audio news stream. We're a live browser-based service. We're news aggregators for financial markets. And so anyone who wants to know up to the second what's happening around the markets, whether it's geopolitical, whether it's financial, corporate news events, commodity-based events as well, the bigger ones, then come to livesquawk.com, get a trial and just see what we do and if it help your trading day. We've been around for the last 20 odd years, and hopefully that's testament to the fact that we're a useful tool for investors and traders alike. Today's event then is really a preview of the ECB rate decision, which is coming in just over an hour's time. We're expecting the central bank to cut interest rates by 25 basis points. I'll let Eric, our European editor, preview the actual event itself, and then we'll introduce some guests really to help discuss and to sort of pick apart the salient points of today's decision, and see if we can just provide a little bit more color and background to what's expected and to what the markets might react to, and potentially, if we get time, we'll have a look at next week when we have a big FOMC rate announcement. We'll also have, I think, Bank of England. Well, I know we've got the Bank of England as well next week. So some key central bank decisions coming up really in September that could pave the way, and in some cases be the start of a rate cutting cycle, and or not. We'll see how that goes. Just wanted to really bring this to our audience and let people just get a bit more insight into what us in the industry look at, what we deem as newsworthy and important, and convey that to our audience really. So that's really the gist of what we're trying to do. Just to give you an idea here, and as I said, if you go to livesquawk.com, it's a free. We've opened up the report for those that want to have a look. If you want to read what Eric Culp, our European editor, has put together, please do. It's if you go to livesquawk.com, latest news, scroll down, and the title is ECB expected to cut rates as Fed prepares to do the same. I'll now introduce Eric, or bring Eric into the room, and hopefully we can then he'll illuminate us on the key points of today's decision. Eric.
Yeah, thanks, Harry. Like you said, the European Central Bank, it's widely expected. Virtually everybody expects them to cut a quarter point of the deposit rate. That's the rate everybody's kind of watching right now. And the other two rates, the refinancing and the marginal rates, are probably going to get knocked back 60 basis points. They're trying to narrow the interest rate corridor. It's something they talked about back in March, and it looks like today's the day they're going to do it, at least, again, widely expected. I think it makes sense for the bank to ratchet down interest rates this time around. Inflation dropped to 2.2%. It's still a couple points up above, a couple tenths of percentage points up above the target, but they held off last time around in July. I think a lot of people are looking more toward growth because that's kind of an issue in Europe right now. I think it was 0.2% in the second quarter for the Eurozone, and the German economy, which is 30% of the Eurozone economy measured by GDP.
Mm-hmm.
Yeah, it contracted. And that's the big concern right now, that the German economy is tanking hard. And if cheaper rates don't come in, it's going to be really bad for the entire Eurozone. Construction has been dropping like a rock, and in the entire Eurozone. Manufacturing also, if you look at the PM9 numbers, they've been terrible. for the past couple of years.
Right.
I think the only thing really holding the anybody at the central bank back might be core inflation, which is at 2.8%. So it's a little high. It's super stubborn. There's concerns about services, but it looks like wages are also dropping right now too, at least according to the ECB's preferred measure. So I think all in all, the smart call. You got to bet on a cut today. The questions are the months ahead. Are they going to cut again next month? Are they going to cut against December? The market's saying December. Some people are saying it could be next month. It's hard to tell. We might hear something today. Christine Lagarde, the ECB president, is known for often saying things she shouldn't. So she might let something slip here. That's almost an even money bet every time she gets in front of the microphone.
Sure.
And then, right now there's also some conjecture about what the terminal rate's going to be. I think Goldman cut it to 2 today or yesterday. And some other observers are saying 2.25. I don't think we'll learn anything about that today. Today, this is already baked in probably. And the questions are going to be, what are the next steps for the European Central Bank?
Thank you, Eric. Again, as I said, Eric's report is out there on our website and up on our X's page as well, for those who want to just have a bit of a deep dive and read through the report. Thanks, Eric. Eric's going to stay on and just help with the roundtable and at the end, where we just discuss really, again, those points that Eric says, terminal rate and what the feel from observers are about where the ECB are at the moment, and whether it's even right to be looking beyond the year end, really, in terms of ECB and the rate decisions. My point would be, because we get a lot of conflicting commentators from ECB members, really, commentary from ECB members around their personal views. So it's going to be an interesting one. Right, I'd like to bring in our next guest. And this is Ilmar Matus. And just to give you a bit of background, because, again, he's a very interesting guy. He's the co-founder of Tickmill, a global multi-asset brokerage firm. It's known for its low-latency trading platforms and focus on algorithmic traders. He's also founder of the Trading Pit, a proprietary trading firm focused on providing traders with capital tools to succeed in financial markets. Matus is recognized for his leadership in fintech and trading industries. So, Ilmar, thank you for joining us today. First time guest. So we really appreciate having you on the call today. And we just want to pick your brains about where you think today's ECB decision lies in terms of importance. And then we'll get the wider perspective on really just from your perspective as a European, someone who is active in the markets, really, with your companies, just what your views are at the moment about just ECB and its effects on the markets. Hi, Ilmar, how are you doing?
Yeah, guys, thanks for having me. So I think as well that we're gonna hit 3.5 today, and what's interesting is that usually before the ECB meetings, what we see, and we have more than like 100,000 active traders, mostly algorithmic, is that there is a big positioning either side, like long or short. What is really interesting before this meeting is that when we look at euro dollar, like it's 50-50, like long and short, and so there is no major positioning. So that would tell me that in terms of them, like market moves, unless Lagarde is going to say something that she shouldn't say, we shouldn't expect any like major market moves. And on top of what Eric said earlier, I think a lot of the attention of the ECB on top of the growth is also going to be going forward on the fiscal matters. So as we know, the war efforts we have in Ukraine, so they are draining a lot of capital from Europe. So I'm myself from Estonia originally, currently in Spain. So a lot of governments in Europe are spending a lot of money on war efforts, and to a large extent, these efforts are not going to result in much more productivity for the whole economy. So that's something to keep in mind as well. So fiscal concerns.
Yeah, the fiscal concerns that I was going to. I mean, I look at the VW news back on corporate side, at least of last week, and productivity issues for Germany. Obviously, got their own political issues at the moment as well, and just how much that would play into ECB thinking, not just for today, but for down the line, and just how worried they might be about German growth and productivity overall, and just fiscal plans. Obviously, we know about France and the fiscal rules that they, having to conform to their budget and everything that we've got going on there as well, and how much that feeds into ECB thinking will be quite interesting, really. So, interesting on that front. Would you so for this, getting back to today, then today's a done deal. We're all pretty happy to sort of say that, though. Where do you see the biggest issues for the ECB? Is it from the fiscal plans around Europe, or is it from still a growth perspective or inflation?
I think it's the challenge that they have, and surely I wouldn't want to be in the position of Lagarde, is that they are kind of maneuvering between various challenges. So on one front, the prices, the inflation has kind of come down, but you still see a lot of pressure from the wages. So that's like a big challenge. We talked about the productivity, so it has dropped. If you look also on the capacity utilization across Eurozone, then this is constantly decreasing, and that's like a red sign as well. I think from the unemployment perspective, it's kind of been dropping, but a big part of the employment is shifting towards not like permanent full-time jobs, but part-time jobs. So I think that's an issue as well. In terms of like pricing pressures in general, I think what's probably helping them a bit is the recent drop in energy prices. So if you look like crude oil and the energy complex in general, and I think recent strength in euro against the dollar, I think that's also supporting ECB from the inflationary expectations perspective. But like I said, I think it's very hard job that they are having right now.
Yeah, for sure. And there's a level of credibility applied to all central banks. We all have our opinion of central banks, and keeping that credibility is obviously an issue. I've got a piece here from I think it's a Bank of America piece. Let me get that. Yes, it is a BAML piece, really. In terms of what they look for guidance now, based on the fact that we do think 25 basis points is baked in for the deposit rate today. In terms of the wording, this BAML report says we expect the wording on the path ahead to be unchanged, emphasizing the data dependence and meeting by meeting approach to determining the appropriate level and duration of restriction. But the risks are biased towards something of a bit more dovish, given the weakening of growth outlook and the internal discussions, according to the ECB sources, on whether that warrants faster cuts. BAML says it's working on the assumption that the ECB will not be ready to send a soft signal this week for the meetings ahead, although it cannot be ruled out. But they could argue that conviction on being on the normalization path is now stronger, given weaker internal demand ahead, which would leave the door open to faster cuts down the line. We still expect an additional 25 basis point cut in December and 125 basis points of cuts in 2025. At this point, I'd like to bring in James Hughes. James, again, I've known James for a while. And we've, as I said, he's been around the block just as much as I have, really. So I just wanted to introduce James. James is a seasoned expert with over 22 years of experience in CFD and FX industry, having worked with some of the biggest names in the financial markets. A regular commentator on global financial news platforms, including the BBC, Sky News, Bloomberg, and CNBC. James is known for providing insights on FX, commodities, and equity markets. And throughout his career, he's held several senior roles, including Chief Marketing Officer at Scope Markets. and he's now the founder of Presco, an education and video content company that provides market and education videos to brokers. Welcome, James.
How you doing?
Excellent. Thank you very much for joining us as well. Just based on what Ilmar says and what that's again that ECB piece I read from Bank of America, and on your market focus now, how do you see the market taking today's cut? And then do you if we do get a more dovish overtone from Lagarde today, where that will take the markets, and what do you think the reaction function is likely to be?
Yeah, thanks for having me on. So obviously, I think, as we've all said, we're all pretty sure that this is baked in already, and that's the problem when we get this initial market reaction, isn't it? Because really the markets probably won't care that much, because they've been looking at this for a while, expecting it probably before this, and being disappointed. And actually this time is probably the first time that we're not going to be disappointed from that perspective. So I think that obviously means we won't get too much. We could get a bit of a shot in the arm for equity markets, because of course you get that little bit more short-term reaction there. But I think in terms of the euro, we may not necessarily get too much jumping around. But I think, as Eric says, Christine Lagarde, we work in these brokers, Ilmar, owner of Tickmill there as well. We want this volatility in the market, and having been in this industry through the times of Jean-Claude Trichet and Mario Draghi, Christine Lagarde is the gift that keeps on giving for us that want this volatility in the markets for clients to trade on, because as Eric said, she does like to put her foot in her mouth quite a lot of the time. So we'll be hoping for that, for something like that. But I think, look, the initial reaction is probably muted. It all depends on how dovish that they are going to be, and I think that's the key point. Where do they go? And I think what we've had from a lot of these central banks recently is each of them waiting for the other to take the lead, if you like. The Fed have been a long time. We waited for the Fed to take the lead. The Bank of England doing very similar. The ECB probably looking to move this a bit quicker. Everyone was waiting for inflation to drop. Inflation dropped down, and then there was still this holding of the breath. So, the big problem probably isn't necessarily inflation as much now. The issue is growth. And I think, as the guys have already touched on, the big problem for Christine Lagarde being too dovish here is the fact that, and Eric, I think, laid it on the plate perfectly there, is that Germany is a mess and construction is absolutely tanking in Germany. So I think that's one of the big problems that we have from that perspective as to where we go next. I think there could be a degree of, people saying to Christine Lagarde to, play it a little bit safe here and try not to cause the euro or any European indices any sort of movements. Whether she will or not is another thing, because we just need to be in a position as we go through in the next few weeks and months or so, just to see where Germany goes, if there's any improvement in those numbers, because I think that is the biggest issue.
Thank you for that, James. So, I mean, and I'll open this up to all our guests here. But do you think this is? Before I do that, just to note, we do have growth and inflation updates. So we do have bank staff updates, projections there, economic projections. We are looking for a slightly downbeat growth shift from the new forecast. But generally speaking, the number of reports I've heard, and not looking for too much, just some tweaking around, again, slightly lower growth trajectory into a back end of this year and next. So in terms of, and again, I open this up for people, what is the biggest worry at the moment for the ECB? Ilmar, what do you think the biggest worry is for the ECB at the moment? We mentioned the fiscal aspects of this as well, and the connotations around that. But will she try? I mean, everyone sort of says she's potentially going to be dovish, and there is more potential for a dovish overtone. So maybe we're overreaching on that side, and there may well be a level of disappointment in the market if she isn't as dovish as many think. But where are the key concerns for today and her messaging moving forward?
I think from her side, probably the biggest challenge is to so at the same time be cautious enough about the inflation and not to be overly dovish there. And as I said earlier as well, that from the wages perspective, there is still a lot of pressure across Eurozone. At the same time, with the German growth and Eurozone growth in general, where it is, and the issues with the construction sector, which is not only in Germany anymore, it's across Europe. So she should somehow give a more dovish signal for the markets and for the economy in general, because even if you look at the PMIs across Europe, the services manufacturing PMIs, then the entrepreneurs' businesses are feeling quite stretched actually. So they want some like positive signal. And also, for example, if you look at the stock markets, then we've been kind of hovering at the same levels since the early months of this year. So everybody's like expecting something, some positive signals, but still remaining cautious on the inflationary front and the fiscal front as well. Super important.
Yeah, and probably understandably on the inflation front, because we haven't seen this drop, this cliff drop from prices that some were expecting. I mean, to that point, we mentioned VW earlier on, and wage negotiations, or sorry, their productivity and their examination of shutting German manufacturing sites. Some say this was a bit of a ploy, really, to get the unions around the table. We now know that Volkswagen and union IG Metall are to begin talks at the end of this month, which I think is a month earlier than expected, in order to try and nail down some wages moving forward. So again, there are suggestions that could have been a bit of a ploy by the manufacturer just to bring the unions to the table and to try and temper sort of wage demands. But we know these things there's gamesmanship on both sides on that front. James, I mean, your thoughts on her, her tone, if you like, at today's meeting?
Yeah, I think obviously that this whole point of being dovish is key, but I think there needs to be one eye on what's going on in the US here, and I'm sure obviously the ECB members and even though they're looking at a lot of homegrown issues that we've already mentioned, the eye on the US there is that really we've got this situation of the US teetering on recession. We've seen over the last couple of weeks, we've seen, that we've got that huge revision in non-farm payrolls a month or so ago. Then we got the worst figures last week, and so growth figures are not good in the US. Growth figures are not good in Europe. So that there's a whole
They're not awful.
They're not awful. No, they're not awful, and I think that's probably the key thing to look at here. So I don't think there's a lot of risk here at being dovish. I think people have been waiting. The markets have been waiting for these sorts of moves for a long time, and to then come out and really not be as dovish as the markets expect. And I think we're not looking at the Lagarde coming out and saying, look, next month we're focusing on cutting again. Looking at December is where the markets are at the moment. That seems fair, and I think the market in general will be pretty happy with, this is the start of this process that we've been looking to do for a while, and we're going to take it. We know the lines, right? We're going to take it steady. This is going to be December, maybe slightly more, but we know these rates have a long way to come down. So I don't think it's too risky to come out and be dovish, or be a little bit more dovish than what she usually is. So I think the chances are we do get that. The only real worry, of course, is if we completely get, and the ECB can do this, completely go against that, where we get just a rate cut and really not much else and that's the fear. Because if you just get the rate cut, not much else, then you see a short-term shot in the arm for an equity market, but then we get pretty longer-term movements lower off the back of that, I think. So that's the fear, but I don't see that. I see it being quite by the book, to be perfectly honest, because we've been waiting for this for a while.
Sure. Just again on that front, in terms of the projections, I think this is from Bamall's report because they do some excellent sort of research. But in terms of the June real GDP, we were looking for 0.9% growth rate for this year. That's the analysts expect that to be downgraded to between 0.9 and 0.7% for 2024. But unchanged, really. I mean, they're looking for a slight tempering to 1.3 to 1.4 in the September projections from 1.4 in June. For 2026, real GDP is expected to be at 1.6. That's an unchanged projection or estimate of what the projection will be. On the inflation front, HICP in the June was seen at 2.5%. That's not looking to be changed for 2025. 2.2% is now being shaved to 2.1 to 2.2. So again, as you were there, 1.9 for 2026. And if you take the core reading for inflation, 2.8 for this year, that's been that may tick up to 2.8, 2.9 for 2024 in the September projections, with the 2025 and 2026 unchanged at 2.2 and 2% respectively. So again, we're not going to get, unless we get wildly varied, wildly different new projections from ECB staff. There's nothing there really to give anyone any sort of meat to the bone, and so I guess it will all be in the language and how Lagarde guides the narrative, I guess, heading into the press conference, which takes place half hour. Eric, is that right? Half hour after the rate decision itself?
Yeah, that's generally when it was scheduled. If I may, this conversation has sparked some activity in my thought box. The first thing I'm wondering is, I'm looking at the construction PMI for the Eurozone. It's been down 28 straight months. My question, of course, right off the bat is that because there was a bubble caused by free money during the pandemic? Is this something that's going to, I've seen like Carson Bresky over at ING, he said it's probably going to, especially in Germany, it's probably going to start moving up again, at least property values. And that, of course, is going to help drive construction. That's one thing I was thinking about. Ilmar, the point about capital being sucked out of the Eurozone into the war is really good, something I've never even thought about. And I'm sure that's also kind of a drag on the economies here. And then on the other hand, again, back to Carsten Bresky at ING, he did note that there was a rise in industrial orders in June, and there was a second one in July. And the report came out. His commentary came out before that report appeared. So, they're really volatile, the industrial production numbers for Germany, but they did rise 2 straight months. Still not a trend. But, are we coming out of this? And then, of course, oil dropping. Does that mean global activity is slowing? The IEA report this morning suggesting that, it's going to be oil consumption is going to decline. So that's often an indicator of a slowdown around the world. So there's a lot going on right now. And I think it's really tough for Lagarde and the European Central Bank to balance all this and to try to run their economies while there's a lot of stuff going on outside of the Eurozone, including what's going to happen next week at the Fed.
Very good point. And that's a really good segue into next week's events. Again, a question for both Ilmar and for James. Is there, like we mentioned, the Fed, and everyone's been waiting really for the Fed to kick off its rate cutting cycle. Is there an element, do you think, from other central banks that they've been waiting for the Fed to signal a more dovish tone and before they really kick on with what they want to say? Waiting on the largest central bank or the largest economy's central bank to come into play? Yeah,
I think so. I think it's always a safe bet, isn't it, to sit there and wait for the US to do it. Now, we expected the US to, I can't remember how many months we were counting down previously when we expected the Fed to do something, start cutting rates. And I think it became, look, not that the central banks are in the game of sitting and waiting and doing whatever the US does, but it makes it a much easier play when when the largest economy in the world or the largest central bank in the world is doing that and acting decisively on those things. The issue we've had here is that there's no one's been acting decisively because the economies have, just not recovered, have they? I think that's the key thing. Okay, we know the growth figures aren't that bad, but still, from a US perspective, it's just very nervy situation. And then what you don't want to be in. I understand the Fed's reluctance to go early. So, it could be a case that we go the other way around here. Do the Fed signal something next week after the ECB go? That's the other question. But I do think it is a case. I mean, especially when we look from a Bank of England perspective, adding them into that, they're most certainly sitting there waiting for someone else to signal that something can that it's okay to start bringing these rates down at a more aggressive pace.
Yeah, Ilmar.
Yeah, I think definitely they are looking after Fed as well, and but I think in general, like both central banks, ECB and Fed, they are somewhat like in this Goldilocks zone right now. So they've seen the inflation coming, somewhat down. Unemployment levels are quite good still, but the growth is not there, whereas inflation risks are still there. So I think it's like a very tricky 3 to 6 months what both of the central banks have. They don't want to be too aggressive. They don't want to be too dovish. The financial markets, equity markets as well are at quite critical points. So if you look at from technical perspective, and we are going into October, which is like seasonally. Historically very difficult month. So I think they are both like really cautious at what they are doing, and rather probably they want to be a bit more dovish than not.
Yeah, no, I wouldn't disagree with that. I mean, again, again for the US, there's the political issues at hand as well, which they have to contend with. Same with the Bank of England. If you look at the budget that we've got coming up there and the austere nature of the new government that's come in and their plans, it kind of muddies the water for a central bank that, from a monetary policy perspective, there isn't. You don't tinker. You either have to do something or you don't do something. You can't tinker and apply a light policy to anything because it just doesn't work that way with transmission. So I totally sort of agree. I think there are issues for all these central banks. Again, I wasn't going to touch on the SNB, but we've got an SNB decision coming up, and if we are looking for any surprises, potentially we could see one from the Swiss National Bank, but that's for another day. So and we will have an FOMC preview next week on the day to discuss the Fed. But it's listen, we're running close to the end of the session here. So just on a takeaway note, FOMC next week. And I'll ask each of you, do you think they signal they go 25 and signal a willingness to continue at a steady pace, or like Citi, who were until last week looking for 350 basis point cuts over the course of the remainder of the meetings this year? Do you think they go bold, or do they will tread easy with their signaling? Lamar, what do you think?
I think they will be quite dovish next week.
Oh, you do?
Yeah, I think so. Yeah.
Okay, cool. James?
Yeah, well, I think it will be the steady start, to be perfectly honest. I think they'll go 25 and then look to ramp up from there. I still think there's a dovish tone to it, but I think there's a nice easy start makes a bit more sense, as you said, with political issues happening and numbers not being great. I think it's a nicer, an easier start for the Fed, I would say.
Yeah. Okay. I mean, my thinking, just briefly on this, and my thinking doesn't matter two squats, but I until last week I was looking at front-loaded Fed because of they're generally behind the curve. I think you look at the Fed and you look at interest rates and the inflation outlook right now, and we've got interest rates where we had inflation at 3.5%, 4%, and now we're sitting where we are with inflation, and we've still got interest rates at 5.25%, 5.5%. So I think that they're behind the curve in that sense, and I don't think we need rates up at these levels. Where you think about inflation, is the growth situation isn't as dire as some thought, and they are guiding towards a soft landing. Hopefully, if that's achievable before they bring rates down substantially. But so I thought they might front load and then look at the situation thereafter. But I think pretty much everyone now is looking for 25 basis points, and that's that for now. But listen, guys, I'd like to thank you very much for joining today. Hopefully, our listeners have got something from it and are a little bit more wiser about what we have coming up in now 40 minutes from now, and obviously then the press conference after that, which I think is the real key to this. We've got PPI data at the US in just under an hour as well, so that's one to watch. Following the inflation data we read out earlier in the week. Thank you again to Ilimar.
Thank you, guys.
Trading Pit, thank you. James of Presco, thank you very much.
Thank
Eric,
you very much.
Eric, thank you, and look out for Eric's reaction piece post ECB rate decision today. Hopefully he'll have something exciting to write about.
Thanks, guys. It was a pleasure.
Thank you, guys.
Yeah, it was really informative for me and hopefully for our audience. And we'll come and do this. Hopefully, we'll come and do this again sometime. So thank you very much. And anyone who wants to trial LiveSquawk, livesquawk.com, go get a trial and see what we do. And hopefully, you'll be pleasantly surprised, and it will help your trading day. And thank you very much. Have a good rest of the week. Now I've got to find out how to turn this off.